An insurance agent is calling seniors right now, promising guaranteed lifetime income. Sounds great, doesn't it? But hidden in that annuity contract are $35,000 in fees and surrender charges. Here's the trick they're using, and you need to hear this before you sign anything. You've probably seen the invitations. Free dinner at a nice steakhouse, educational seminar on retirement planning, no obligation. Just come learn how to protect your nest egg, and the pitch sounds incredible. They're promising you guaranteed 6% growth every single year, no matter what happens in the market. They're offering lifetime income you can never outlive, even if you live to 105. They're telling you they'll protect your retirement from market crashes, from another 2008, from losing everything you've worked for. The room is full of people your age, nodding along. The agent has charts, testimonials, and a smile that says trust me. And honestly, after decades of market volatility, after watching your 401k bounce around like a ping pong ball, the idea of guaranteed anything sounds like exactly what you need. But here's what they're not telling you at that dinner. The hidden fees. Let's start with the commission. The agent sitting across from you, the one who seems so concerned about your retirement, is making 6 to 8% commission on whatever you invest. On a $250,000 annuity, that's $15,000 to $20,000 they're pocketing. And you never see this number. It comes right off the top, built into the contract. Then come the annual fees, typically 2 to 3% every single year. That's another $5,000 to $7,500 annually on that same $250,000. These fees pay for the insurance guarantees, the death benefits, and the company's overhead. Want that guaranteed lifetime income rider they mentioned? That's an extra fee, usually 0.5 to 1% per year. Death benefit, another 0.5%. Long-term care rider, add another 1%. Each guarantee comes with its own price tag, and they stack up fast. But the real kicker is the surrender charge. This is the penalty you pay if you need to get your money out early. It typically starts at 7% and declines over 7 to 10 years. Try to access your own money in year 3. You're paying a $17,500 penalty on $250,000. When you add it all up, commission, annual fees, rider fees, and surrender charges over the holding period, you're looking at $35,000 to $50,000 in total costs on a $250,000 annuity. That's 14 to 20% of your principal, gone to fees. I want to tell you about Frank. He's 69, lives outside Philadelphia, retired machinist, worked 40 years, saved carefully, had about $280,000 in his IRA. He went to one of those free dinner seminars in 2019. Ribeye steak, good wine, nice presentation. The agent convinced him to move the entire IRA into a fixed indexed annuity. Guaranteed growth, safe from market crashes, lifetime income. Frank signed the papers. Year 3, Frank's wife needed emergency surgery. Insurance covered most of it, but they needed $25,000 for out-of-pocket costs and rehab. Frank went to withdraw from the annuity. The surrender charge was $19,600. That's 7% of his principal, just to access his own money. He'd already paid $16,800 in accumulated annual fees over 3 years. And here's the worst part. His actual account value had only grown 2.1% per year, not the 6% they'd promised. He could have made more putting it in a certificate of deposit at his local bank. Frank had to take a loan against his house to cover the medical bills because accessing his retirement money was going to cost him nearly $20,000 in penalties. That safe investment trapped his money when he needed it most. Let's talk about that 6% guarantee, because this is where the real trick happens. When they say 6% guaranteed growth, you're thinking your $250,000 becomes $265,000 after year 1, right? That's what growth means in normal English, but that's not what they mean. That 6% applies to something called the income base or benefit base. This is a phantom number that exists only to calculate your future income payments, your actual account value, the money you can access, the number that shows up on your statement. That's growing maybe 1 to 3% per year. So in year 1, your income base goes from $250,000 to $265,000, but your actual account value might only go to $252,500. You cannot withdraw that $265,000. You cannot transfer it. You cannot leave it to your heirs. It's not real money. It's a calculation number. The only thing that 6% income base does is determine how much monthly income you'll get if you annuitize. If you convert the contract into a stream of payments, and even then, the actual payment is a percentage of that income base, typically 4 to 5%. So your guaranteed 6% growth translates into maybe a 4% withdrawal rate on a number that's artificially inflated. It's a classic bait and switch. They advertise the 6%. You think that's your return. You sign the contract, and then you discover it was all smoke and mirrors. The actual returns are barely keeping pace with inflation, while the fees are very real and very expensive. Now, I'm not saying annuities are always bad. There are specific situations where they make sense, but they're narrower than the insurance industry wants you to believe. If you're 75 or older, you have no heirs or don't care about leaving money behind, and you need guaranteed income to cover basic living expenses, a simple, immediate annuity can work. You give the insurance company a lump sum, they send you a monthly check for life. Simple, straightforward, no tricks. The key word there is simple. Immediate annuity. You're buying a pension, essentially. You hand over $100,000. They send you $500 a month for life. The fees are built into the payment calculation, but at least you know what you're getting. What you want to avoid are the complex products, indexed annuities, variable annuities, equity indexed annuities. These are the ones loaded with fees, surrender charges, and confusing terms. These are the products that pay the highest commissions, which is why agents push them so hard. And you should only consider any annuity after you've maxed out other options. Social Security should be optimized first, delaying if possible to get the higher benefit. Pension decisions should be carefully analyzed. A diversified portfolio of low-cost index funds can provide income with more flexibility and lower fees. Annuities should be the last resort, not the first option. If someone is pitching you an annuity right now, slow down. Don't sign anything at the seminar. Don't let them pressure you with "this offer expires tomorrow." Take the paperwork home. Better yet, take it to a fee-only financial advisor who doesn't sell annuities and has no incentive to recommend one. Ask specific questions. What is the total commission being paid? What are all the annual fees, listed separately? What exactly is the surrender charge schedule? What's the difference between the income base and the account value? Can they show you the actual historical returns, not projections, of this specific product? If they can't or won't answer these questions clearly, walk away. If they pressure you, walk away. If they use phrases like "this is what all my clients are doing" or "you don't want to miss this opportunity," walk away. Your retirement savings took decades to build. You don't need to make a decision in one evening over a free steak dinner. The right financial product will still be available next week, next month, next year. The wrong one can lock up your money for a decade and cost you tens of thousands in unnecessary fees. And if you've already bought an annuity and you're in that surrender charge period, you still have options. Some contracts have free withdrawal provisions, usually 10% per year. Some have exceptions for nursing home care or terminal illness. Read your contract carefully, or have someone knowledgeable read it for you. There's also the free look period, typically 10 to 30 days after you buy, where you can cancel without penalty. If you're in that window and having second thoughts, use it. Don't let embarrassment or pressure keep you in a bad financial product. The bottom line is this: the complexity is not in your interest. The more complicated the product, the more ways there are to hide fees and limit your access to your own money. Simple beats complex almost every time in retirement planning. And if someone is making a large commission on your decision, their interests are not perfectly aligned with yours, no matter how nice they seem. You worked too hard and too long to let high fees and surrender charges drain your retirement savings. Ask questions, get second opinions, and never ever make major financial decisions under pressure or at a sales seminar. Your future self will thank you.